Here we go. Hello, my name is Patrick Bradley. Thank you for tuning in. This is part one of a three-part series where I am interviewing subject matter experts, Randy Sadler and Chris Gallo from CIC Services, LLC. They manage captive insurance companies, a topic I am fascinated about. So Randy and Chris, thanks very much for joining us this afternoon.
Thanks, Patrick. It's great to be here.
So let's start off with the easy question. So tell us, what is a captive insurance company?
The best way to understand it is it's akin to a health savings account, whereby an individual will put pre-tax dollars into their HSA to pay potential future health insurance bills. So a captive insurance company is like an HSA, but instead of it being an account, it is an actual company. It's an insurance company that's domiciled in a particular jurisdiction, and it is regulated as an insurance company, where the business owner will pay premiums to his wholly owned captive insurance company to build up the assets. In the event that there is a loss down the road, he could use those assets that he built up into his captive insurance company to pay those claims of the business that he is insuring. So that's the best way to explain kind of what a captive is.
Okay, excellent. Nice analogy. Thank you, Chris. So next question, what else does a captive do?
Yeah, so a captive really can work in conjunction with commercial insurance. So a business owner is able to own a captive insurance company, and he or she can have that insurance company insure the business. Now, it may replace some of the commercial insurance. It may fill in gaps in the commercial insurance coverage. It may also insure, risks that aren't insured at all. So, it gives the business owner great flexibility to create, a stronger web, if you will, of insurance protection for the company. And it's particularly relevant to manufacturing.
And also, they insure core risks and non-core risks. Everyone's kind of familiar with the core risks, like general liability, workers' comp, auto liability, health, directors and officers liability insurance. Those are examples of core risks. But also a captive insurance company, you can insure non-core risks. These are risks that are either unable to be insured in the commercial market or they are underinsured in the commercial market. Some examples of non-core risks are vandalism caused by riot, business interruption, and warranty, etc. So I'd like to talk about that vandalism caused by riot, because you may have heard in Portland, Oregon, there was a husband and wife who had a store with merchandise. They had like $300,000 or $400,000 of merchandise in their store, and they had coverage protecting them against vandalism, break-in, and theft. And in Portland, Oregon, there was those riots whereby individuals broke into the store and they took all their merchandise. However, even though they had commercial insurance, the commercial insurance had an exclusionary language in their policy, whereby they said if there was looting and theft of the merchandise, but if it occurs during a riot, the insurance company did not have to pay that claim. So it's exclusionary language. What are the things what a captive insurance company can do? We could go to the business owner. The business owner could get the commercial coverage for regular break-ins and theft, etc. But in the event of another riot, we could also put a policy in place whereby we can protect those business owners against looting and theft in the event of a riot. And also any combination. So we like to say that a captive insurance company can insure the core risk, non-core risk. Randy alluded to fill in the gaps. If there's language where it would exclude coverage, the captive can be personalized for that individual business owner's needs.
Got it. Okay, thank you. So next question that I have for you is basically, how do these work?
Yeah, that's a great question. And this slide gives you a really good illustration. You see the shareholder at the top. This is the the business owner in many cases. It doesn't always have to be the business owner. And then we see the business on the left. Let's just call the business on the left a manufacturing company. And so you see that they pay premiums to the captive insurance company on the right, and they transfer risk over to the captive. The captive in return issues insurance policies to the manufacturing company or the business on the left. Now, a captive is a real insurance company. It's licensed, and so it has to get its license from somebody, right? Captives are regulated by the states, and so captives can get their license from the states that they're domiciled in. And in some cases, captives have their domicile or get their license from an offshore jurisdiction. We typically like to focus on having captives in the United States, regulated by a U.S. state with a U.S. regulator overseeing the captive and making sure that everything is working well. Now you'll notice at the top it says shareholders. Well, this is often the business owner, or it could be a holding company. But this is really unique because it doesn't have to just be the business owner. We've worked with companies before that have some of their key employees own part of the captive. So if you think about that, every time the insurance company is profitable, their employees are building up wealth as well. So it's a great incentive for key employees to control losses, right? They don't want losses because obviously it's going to be coming out of their wealth as well. And so it's a great way to tie the goals of the business from a risk management standpoint with the goals of key employees. That's a quick snapshot of how a captive works.
I'd like to add
great.
a couple points.
Yes,
So
sir.
you can see that arrow where the business sends premiums and risks to the captive insurance company.
Yes.
But unlike a traditional insurance company, whereby the business owner sends the premiums and the risk to the commercial insurance company, and you see that top arrow where it says the insurance policy is going back to the business. If there is a loss, that captive insurance company pays the money to the business owner, And in the event that there are low losses, the assets that build up in that captive insurance company still stay in that holding company between the shareholder, the business owner, and the captive insurance company. It stays in that same holding company. Therefore, the assets remain with this organization.
Got it. Okay, thank you. So next question that I have for you is, what are some parameters of the business that, so if I'm a manufacturing company, how do I tell if I'm a good fit for a captive?
Yeah, that's a great question. So, what we normally encourage businesses to do, whether it's the CEO or the CFO or the owner or the risk manager, is first look at all of the insurance spending that you have. Look across all those lines. Look at your general liability, your property, your workers' comp, health insurance, and also look at product liability, product recall, and warranty, frankly. And if you're looking at $250,000 or more of total spend across those lines, you should at least explore a captive. It may be a good fit for you. We also typically find that businesses that have gross revenue of $5 million or more are potential candidates for a captive. And they may not think they are, but there may be areas they're not ensuring that they should be, where a captive would be, a really good fit. So those are two really good thresholds: $250,000 or more of insurance spending, $5 million or more gross revenue, to at least take a look at a captive.
Okay.
One little item I would add, Randy talked about revenues and insurance spends, but even if a business owner has $500,000 of earnings a year, there are times that a captive in certain situations may make sense for that business owner. So that's another threshold to consider.
Are there any thresholds that have to do with the number of employees?
There can be, yeah. One of the things that we often do, and we didn't really cover this at the outset, but captives can take over part of a manufacturer's health insurance plan. So they essentially take a layer of the health insurance. We normally put stop loss on top, and then a captive layer. We do everything that a normal health plan does. It has a third-party administrator, pharmacy benefit manager, and network. So it works the same way. The difference is that the business owner is able to self-insure part of their healthcare risk. If they have 50 or more employees in their healthcare plan, this may be a fit for them. And we typically see savings of between 10 and 15% on healthcare costs when we do a plan through a captive. So it can be really lucrative.
When Randy talked about taking a layer of the risk, we talked earlier about working in conjunction with the commercial insurance market. And based on the risk appetite of the business owner, sometimes a business owner can form a captive and just take a small layer of the risk at first. And as he gets comfortable with the whole situation, we've seen captive owners say, hey, you know, we like this, we want to take more risk on, and therefore more profit to their captive.
Got it. Okay. So another question, what are some common misconceptions that are out there in the marketplace?
Yeah, I think probably the most common misconception is that captives are for large companies. And that simply is not true anymore. It would have been true, say, 30, 40 years ago, perhaps, because it used to cost a lot of money to start a captive insurance company. There are only a few states that license captives, New York being one of them. Usually cost about $500,000 to form your own insurance company and get a license. They usually required $1 million of capital. And so that kind of made captives a vehicle for the larger corporations only. But starting in the 1990s, Vermont really had captive legislation to reach out to small mid-market companies. Other states have followed. There's between 35 and 38 states that license captives now. Their cost to form the captive and their licensing is lower. The initial capital required is lower. So it's really opened the door for small and mid-market companies to own their own insurance company, take on some of their risk, and then the reward is profiting when they have low claims. So what a huge win for the small and mid-market. And we see a lot of manufacturers using captives as well. So that's probably the first misconception. Any others come to mind?
I was going to say, well, you talked about how it used to be big companies. I'd say like 90% of the Fortune 500 companies have captives.
Yeah.
But with legislation changing, so now Connecticut's got pending legislation whereby the minimum capital surplus requirement is being reduced from $250,000 down to $50,000. And that was all done because they're trying to encourage small business owners to get into formalized self-insurance via a captive insurance company. So it's basically a disruptive industry, captives, and we see that things are changing. So what is originally started off with captives, today it looks totally different. I think the business world is constantly discovering ways that a captive insurance company can aid their enterprise.
Yeah.
Fascinating.
Good point. I guess the other misconception, which is always worth noting, is that sometimes captives are wrongfully tarred and feathered as nothing but some kind of clandestine offshore tax scheme, which there may be a few businesses that have used captives in abusive ways and maybe done something like insured hurricane risk in Kansas for lots of money, but that's really the exception, not the rule. The vast majority of captives, especially if they are domiciled in the United States, have a U.S. regulator looking over their shoulder, and they're not going to let them get away with that kind of nonsense. So
Sure.
You got a U.S. regulator looking over your shoulder, looking at the insurance policies, looking at the actuaries' work, and looking at making sure that it's solvent and that it makes sense. Then that kind of tomfoolery is not going to happen.
Got it. Okay, gentlemen, that should do it for part one. So next time in part two, we're going to talk about how captive insurance companies can improve cash flow, profit, and liquidity. And then in part three, we're going to take a look at how captive insurance companies can be used as a creative tool in the company owner's toolbox. So gentlemen, thanks very much for your time this afternoon. I appreciate your cooperation in getting this done.
Patrick, thank you for inviting us.
All right. Bye for now.